Welcome back to the channel. Today, we are diving into a crucial topic that affects many people's financial journeys: debt consolidation versus loan refinancing. Both options have their merits, and understanding the differences can empower you to make informed decisions about your financial future. So let's break this down and analyze these two strategies closely. To begin with, let's clarify what we mean by debt consolidation and loan refinancing. Debt consolidation involves combining multiple debts into a single loan, often with the goal of securing a lower interest rate or more manageable monthly payment. On the other hand, loan refinancing refers to taking out a new loan to replace an existing one, typically to achieve better terms like a lower interest rate or a different repayment period. While these processes might seem similar at first glance, they serve distinct purposes and can lead to different financial outcomes. Let's first consider liquidity. When it comes to managing cash flow, both options can provide some relief. Debt consolidation may help streamline payments by reducing the number of creditors you deal with. This simplification can enhance your liquidity as you'll only need to make one payment each month instead of several. However, if you are consolidating high-interest debts into a longer-term loan, you might find that your overall interest payments increase over time, potentially affecting your cash flow negatively. Conversely, refinancing allows borrowers to adjust their current loan terms to match their financial situation better. If you refinance at a lower interest rate, you could see immediate improvements in your liquidity since less of your monthly budget goes toward interest payments. However, if refinancing extends the term of your loan, it might not improve your liquidity in the long run due to accumulated interest. Now let's talk about accessibility. Debt consolidation loans are often marketed to those struggling with multiple debts, making them accessible for individuals looking for quick relief from overwhelming payments. This can be particularly appealing for those with poor credit scores who may find traditional financing difficult. However, many debt consolidation options come with specific requirements that must be met, such as income verification or minimum credit scores, which can restrict access for some individuals. Refinancing typically requires a good credit score and a stable income to qualify for favorable terms. While this might limit accessibility for some borrowers initially, achieving a successful refinance can open up further opportunities down the line. It's essential to assess your current financial health before pursuing either option. Profitability is another key aspect we should analyze. In the context of debt consolidation, the goal is often to reduce interest payments and simplify financial management. If done correctly, it can lead to significant savings over time. However, there is a risk that individuals might accumulate more debt after consolidating if they don't change their spending habits. Refinancing can be incredibly profitable when market conditions are favorable, like securing a low fixed-rate mortgage when interest rates drop. Yet if you refinance frequently or take on new loans with longer terms just to reduce monthly payments, you may end up paying more in total interest over time than if you had stuck with your original loan. Risk is an inherent factor in both strategies. With debt consolidation, there is a risk of falling into the trap of accumulating new debt after combining existing debts. It's easy to feel like you've reset your finances and subsequently make impulsive spending choices without addressing the root cause of your debt issues. On the other hand, refinancing carries its own risks, most notably market fluctuations that can affect interest rates after you've locked in a deal. Additionally, if you're not careful about the terms of your new loan, you could end up extending your repayment timeline unnecessarily or encountering prepayment penalties that diminish potential savings. Lastly, let's reflect on the psychological factors associated with both options. For many people burdened by multiple debts, debt consolidation can provide immediate relief and peace of mind by simplifying payments into one manageable sum. This psychological benefit can foster positive financial behaviors moving forward as individuals feel more in control of their finances. Refinancing might also bring peace of mind, but could create anxiety around maintaining eligibility for better rates and navigating lender requirements. The decision-making process can be stressful if you're uncertain about which path offers the most sustainable relief. So where does that leave us? Both debt consolidation and loan refinancing have their advantages and disadvantages, each appealing under different circumstances depending on individual financial situations and goals. It's essential to weigh these factors carefully before deciding which route to take. Before wrapping up this discussion, I encourage you all to share your thoughts in the comments below. Have you experienced either debt consolidation or refinancing? What lessons did you learn from your journey? Your insights could help others navigate their financial paths more effectively. If this video has provided value or sparked reflection on your financial journey, please give it a thumbs up and consider subscribing for more expert insights on personal finance topics. Thanks for tuning in today. Until next time.